Good afternoon, everyone. I welcome you all to a corporate session on corporate tax and compliance in real estate, and that is conducted by Spectrum Auditing. Here, we will be diving deep into what implications corporate tax has and what VAT implications also have on the real estate industry. So, we at Spectrum Auditing have been in the UAE for the past 8 years, and we specialize in audit, accounting, VAT, corporate tax, and as well as internal audit. We also provide risk and advisory services as well. Today, we have our first speaker, Mr. Balaram Reddy, who is a managing partner at Spectrum Auditing. He is also a chartered accountant and has been here for more than 20 years. He has more than 20 years of experience and has worked with Big Four audit firms like KPMG, Deloitte, and PwC. We also have a second speaker, Mr. Manish Saraf, who is also a partner at Spectrum Auditing and is a chartered accountant. He is also a certified internal auditor who has been in the UAE for more than 20 years and has worked with Big Four audit firms such as Deloitte and PwC. So, without further ado, let's give the floor to them.
Thank you, Arins, for this introduction. Good afternoon, everyone. So today we are going to cover about the corporate tax specific to the real estate and also the VAT compliances which are to the real estate sector. So what we have done is today we have compiled the informations as per the federal decree law and the different ministry decision and cabinet decisions. So this has to be, once we apply to the business, this needs to be read through from the original source, the views which are presented, our own interpretation, and then for any further application into the business, you need to consult your advisors and read the original decree. So today we're going to cover about, of course, give a brief background about the corporate tax in the UAE and which are the person which is taxable and what rate it is taxable, then what is a group in UAE, a qualifying group and a tax group, and how does it different from a VAT? And then what are the expenditure which are allowed or disallowed? And within the qualifying free zone, how it is applicable to a commercial property or residential property, within the VAT and the corporate tax implication on the real estate business. Then what are those connected persons, the transactions which are there, and how the record keeping has to be maintained for them, and the general accounting record which is required as per the compliance of corporate tax federal decree laws, and what is the tax administration, the return filing period, the documentation required for that. And as we go through this, so whatever queries you come across on any point, please raise your queries on the chat box. We will address at the end of the session. So if you see the how the tax has evolved, how the compliances has evolved over the last 4-5 years. It was started with country by country reporting, the CBCR, which covers the large multinational enterprise with a revenue turnover of 3.15 billion dirhams. So they have specific requirement of reporting. And then we have economic substance regulation, which are for specific business activities pertaining to the share your holding business companies or your distribution service center businesses. There are specific activities for which they need to prove the substance. Then, as you all be aware of, value-added tax, which is for the sales, and then the excise for the manufacturing units. Then we have then anti-money laundering, primarily applicable to the banking, financial sector, and as well as the non-financial sectors, which covers the gems and jewelries and other businesses for which they need to do the compliances. And then we have finally the corporate tax, which is applicable on the business profit, on the income which the company derives it. And whereas the VAT is applicable on the sales, the 5% is on the sales, whereas the corporate tax is applicable on the business income. So if you look at the geographical form of UAE, it is divided into mainland and your free zone, and then there's an offshore. So mainland we are all familiar with, which is basically Dubai mainland or Sharjah or any other Emirates. Whereas free zone is there are more than 40 plus free zones in UAE, and it is categorized again into financial free zone, which is DIFC, ADGM, then other free zones where we get a license to carry out the businesses. And then there is an offshore. So for corporate tax perspective, free zone and offshore have a similar taxable impact. And if you see the legal form on the right side, it is the blue colors are the one which where the individual and the business is not separate. So sole proprietorship, civil company, partnership. So individual is the same as the business. Whereas on the right hand side, if you can see limited liability company, public shareholding, private shareholding, so the company is separate and the individual is separate. So the tax is applied on the business income of the company. And so the legal firms plays a critical role because the taxability would vary depend upon the legal form that entity has as an individual or as a company. So if you see that the corporate tax has been implemented with effect from 1st June 2023, but it would depend upon the real applicability would depend upon the financial period. And the financial period for the corporate tax is 12 months period. And if we say a company has a financial period from 1st July till 1st July 2024 to 30th June 2025, so for them it is applicable from next year. But and this year itself, there was the 1st July 23 to 30th June 2024. So for them, it is applicable from 1st July 23. And there is the return has to be filed 9 months after the end of the financial period. So 9 months after the end of financial period, 30th June 2024 is 31st March 2025. So in corporate tax, there is one annual return, whereas in VAT, we see there is a quarterly return being filed, and those which has a financial period from Jan to December. So the first tax period would be 1st Jan 2024 till 31st December 2024. And then the first return filing period would be 9 months after the end of December, which is 30th September 2025. So if you look at the personal tax rate, which is applicable here for corporate tax, it is general and or a qualifying free zone. So a general tax rate is like there's a slab up to 375,000 income, business income, there's 0% corporate tax. And beyond that, there's a 9%. So if a company has a business income of 500,000, so they would be paying 9% for over and above 375,000. That is, the tax would be paid on 125,000. And there's another concept of qualifying free zone. Under the qualifying free zone, for the qualifying income, 0% tax is applicable. So we will look in the later phase that what is the definition of qualifying free zone. And then for the income person who's under the qualifying free zone but making some non-qualifying income as well, then on that he would be paying straight away 9%. So there is no slab of 375,000. The straight away 9% would be paid on whatever income is derived by a qualifying free zone person for his non-qualifying income. So there is a difference of qualifying income and non-qualifying income, which my colleague Balram will take over later. So if you look at overall picture of taxability, the taxable person could be either resident person or a non-resident person. A resident person could be incorporated in UAE, either in mainland or a free zone, and then or it could be also incorporated outside UAE. So that means a person could have a business in Malaysia, in Singapore, or any other country. He has a legal entity outside UAE, but that business is being controlled from UAE. The person, the key management person, the decision making is happening from UAE, though that company is not established in UAE, could be in Singapore or in Malaysia. So whatever income is earned from that Malaysia or Singapore, he would still pay a corporate tax in UAE. But then there would be a double tax avoidance agreement, which would be setting of whatever tax is paid in outside UAE and then UAE. Then when it comes to the natural person is also taxable, but with certain limitation. I mean, it should be the commercial business activities similar to what a business would carry out. So if we look at the natural person, here is the natural person. There are three categories of income under which a natural person individual will not be paying tax. So he will not be registering as under the corporate tax. The first is the wages, the normal salary which you would earn as an employee will not be taxable, or even like bonuses and allowances being paid as part of his compensation, it won't be taxable. And as an individual, if he is having a personal investment, like some people who do a share trading, that will not be taxable. The income earned based on the share trading market, that won't be taxable because generally there is no specific license being required to carry out that activity. And when it comes to the real estate business, the person could have some real estate unit, like he has some villas, he's renting out, or some units in a particular building where he's earning rental income as an individual. If that property is owned in the individual name, then that won't be taxable. But if it is in the name of the company, corporate, that would be taxable. So we will look at that. What are the different scenarios under which a real estate would be taxable under corporate tax? And then other than these three categories of income, if he is making any other kind of businesses, like if he is doing a freelancing, consulting services, or any other, then he would be taxable. And if his income, his revenue is more than 1 million, then he need to register under the corporate tax. But if it is less than 1 million, then he need not be registering under the corporate tax. The corporate tax liability doesn't arise. But if it is more than 1 million, other than this three category of income, then he need to register and pay the tax liability. So, besides resident, the non-resident is also taxable. So, non-resident could have three form of business in UAE, having a permanent establishment in UAE. That means he does is not registered in as a separate legal entity, not a resident. So he has a permanent establishment. That means it has a branch. So company in India is having a branch in UAE through which it operates its business. It could be selling electronics or garments through trading through a branch in UAE. So that is becoming taxable in UAE. Or it could be deriving any source of income. That means it doesn't have a branch in UAE, but it is running its business through a agent through which he is selling the electronic item. That means supplying from India to the agent in Dabza or any other free zone or any mainland, and he's earning income out of it. Then that also becomes taxable. Or there could be third category has any nexus in UAE. That means any kind of source of income being earned from UAE become taxable. So recently, for the non-resident is having a immovable property in UAE and earning any kind of revenue from that property, then that become taxable. That's a nexus being covered recently by the cabinet decision. So now looking at the tax group, how the tax group can be created, and how what is the qualifying group. So a tax group in under the corporate tax and the VAT, what difference it is, what are the criteria for it? If you look at it, first is it need to be a judicial resident person. That means only a legal entity, which could be LLC company or public private stock companies. Like the legal form has to be there. Individual cannot form a tax group, so it has to be legal person. Similar criteria is also there in the VAT. There also needs to be a legal person. Then the next criteria is having holding a 95% ownership interest or a profit or a voting right in the company. So then only it can form, like there's a ABC company. So on that ABC company, it has to hold direct or indirect holding of 95% to be eligible to form a tax group. And whereas in the VAT, it is 50%. So you need to hold 50% control or voting right or a profit share to be eligible to form a VAT group. And then neither the parent or subsidiary are exempt or qualifying free zone. That means a corporate tax group can be formed under the corporate tax only when they are paying the same rate of tax. So if like because the exempt or a qualifying free zone has a 0%, so they cannot be forming a grouping with the company which is paying 9% and 0%. So it has to be the same category. So it cannot be an exempt or qualifying free zone to form a tax group. It has to be a normal tax rate paying companies. Then only they can form a tax group. And the same financial period has to follow because the financials are consolidated. So same financial period. That means if a company A is for has a parent company P and subsidiary A and B, then those all three companies, P company, A and B company as well, should be following same financial period, that is Jan to December or April to March, whatever, it has to be the same because those financial are consolidated. So to be eligible for tax group, the same financial period need to be followed. And then the same accounting standard, because IFRS is generally prevalent here as an accounting standard. So that accounting standard should be followed so that it can be compared and consolidated. And then in the VAT, if you see that the criteria is business and fixed establishment in UAE can also form a tax group under the VAT group. So whereas in corporate tax, it is only the judicial resident person. So a permanent establishment, a branch of a Indian company or any other company outside UAE cannot form a tax group in corporate tax. Whereas in VAT, it can form because a permanent establishment, a fixed establishment can be considered, a branch can be considered to form a tax group. And either each member of the group meet the threshold, that means the threshold of 375,000 as an individually one company or a group company should meet up the criteria to be eligible to register for VAT. So as I was mentioning regarding in the corporate tax group, there could be a direct or indirect also. So if a parent company A has a entity B in the Dubai mainland, which parent company A holds 100% in entity B in Dubai mainland, and then there is an entity C in the Sharjah mainland, where the parent company is holding 60%. So it's not holding 95% here, but indirectly it holds 100% through entity B because parent company A is holding 100% in entity B, and then entity B is holding 40% in entity C. So altogether, parent company is holding indirectly the entity C also, which is more than 95%. So parent company A, B, and C can form a tax group under the corporate tax. Now, in this scenario, if you look at parent company A, I mean the same Dubai mainland entity is there B, but there is another entity C which is in DMCC, which is a qualifying free zone person. So here this, because it is a qualifying C, now here is a qualifying free zone person where the tax rate is 0%. So now it cannot form a tax group with A, B, and C. So the only tax group which can be formed is between A and B because they are the same rate of corporate tax paying entity. So 9% is being paid by A and B, the conforming group, whereas C is a qualifying free zone person, so it cannot form a tax group with A and B. So now what is the effect of having a corporate tax group is that it is treated as a single taxable person. That means the threshold limit of 375,000 is common, is applicable for the group. So ABC, there is a single limit of 375,000. Whereas if they would have not formed the tax group, then in each A, B, and C would have availed that threshold of 375,000 for each of this company. And then the parent company need to comply with the obligation of corporate tax registration, filings, corporate tax payment, and then the financial statement need to be consolidated for A, B, and C, and any intragroup company transactions which are there need to be eliminated. And then the parent and subsidiaries shall be jointly and severally liable for corporate tax. That means company B and C need to be also liable to pay the corporate tax together with the parent company. And the group shall cease to exist if they don't meet the criteria. Like there was a 95% requirement of holding. If that 95% is reduced, it reduced to 80% during the year, then the tax group will cease to exist. And also parent company can be replaced through an application. That means currently parent company A is there, but someone has other companies taking over the parent company A. Then the new company, D is coming into picture, who has taken over the parent company A. Then the D company become the parent company of A, B, and C, and it can form a tax group if it meets the criteria of 95% and other criteria mentioned. Then if you see under the VAT, the group, what the effect of the tax group in the VAT is that there is a single TRN number and the company is treated as single taxable person for the group. And any supplies made between the group companies, those need to be disregarded. The VAT is not paid within the group company transactions. And then they would be jointly and severally liable for paying the tax, VAT tax. And then the tax group submits only one tax return, which is a quarterly return summarizing the supplies and purchases made by them. And one member of the group is considered to be a representative member for filing of the return. So it is declared that who is the representative member for the group A, B, and C that will be filing the tax return, VAT return. Now, other than that, of a tax group, there is another criteria of qualifying group. So if they are not able to meet the 95% holding criteria, then they can still be considered for the tax losses or carry forward adjustments. So which is like if they are holding, the first category remains the same, that they need to be a resident person to form a qualifying group. And then the other criteria is that 75% of interest is to be holded, whereas in the tax group it was 95%, but for the qualifying group it is 75%. And again, it could be direct or indirect. And then it need not, the I mean, a qualifying free zone person or exempt person cannot be grouped together, as I mentioned earlier, that it, because the 0% is for the qualifying free zone person taxability, the tax rate is different, so they cannot be forming the tax group, I mean qualifying group. And then the same financial period has to be followed, and the counting standard remains the same. And also the taxable limit, I mean the maximum up to 75% of taxable income can be transferred or reduced among adjusted among the other entities. So we look at what is tax losses and how this adjustment can happen within the qualifying group and general as well. So if you look at the tax losses relief, if the tax losses relief can be available under the corporate tax only from the year when the corporate tax is getting implemented. So if the companies which have a financial period from Jan to December, so the first tax period for them is 1st Jan 2024 to 31st December 2024. So the tax losses which are there for the period of 2024 only can be carried forward and adjusted in the next year. So if they have any losses in 2023, that cannot be carried forward because corporate tax is not applicable for those financial period of Jan to December in 2023. So the tax loss of 2023 cannot be carried forward. But if their losses are there from the period which is implemented, corporate tax is implemented, from that period onwards, they can carry forward. And the maximum set off allowed is 75%. So only 75% of the future income being earned can be set off against the losses being carried forward. And also there's one clause that, if there's any change in the business in the future, so there is a loss in 2024 and in 2025 the business has changed, but the change in the business should not be more than 50%. Like, the business was carrying on the trading activity, that business should remain the same, or the shareholding of common shareholding should not be changed, should not be more than 50%. So here's an example of how the tax losses can be adjusted. So suppose in 2024, there is a tax loss of 275,000. And then this 2,075,000 can be carried forward in 2025. And so in 2025, the company earned, there's a profit of 100,000. Out of that 100,000, the limit of adjusting the previous year loss is 75%. The 75% of 100,000 is 75,000. So out of previous period income of 275,000 losses of 2024, only 75,000 can be set off because 75% of 100,000 is 75,000. Then the balance remaining can be carried forward. So from 2,075,000, 75,000 has been set off in 2025. So the loss balance is 200,000. So this loss of 200,000 can be carried forward for the future period. And then in 2025, the net after adjusting the loss is income remaining is 25,000. And since it is below the threshold limit of 375,000, so there is no tax. And then in 2026, there is an income of 1 million. Out of that, 75% is allowed, that is 750,000. And but the carry forward loss was 200,000. So this loss of 200,000 can be fully adjusted. And this taxable loss which is carry forward is like until indefinite period, so there is no time limit up to which you can carry forward the losses can be carried until till the time the business exists, the business is being carried or continued, so that losses can be carried forward until indefinite period. Now within the qualifying group, so there is a qualifying group which a common shareholding of 75%. So A and B are qualifying group. How the tax losses are adjusted within the qualifying group is that, see, if you see in company A had a loss of 550,000, out of this 550,000 can be adjusted against the company B income, the other qualifying group company. So now the company B had an income of 600,000. So out of 600,000, only 75% can be set off of a company A. So say 75% of 600,000 is 450,000. So out of 550,000, so 450,000 can be set off. The balance remaining will be carried forward. So the balance which is remained after that is 100,000. So 100,000 can be carried forward to be for the future period. And for company B, after setting off the loss of 450,000, the remaining income is 150,000. And since the income of 150,000 is less than the threshold limit of 375,000, so the tax payable is zero in this case. Now coming to what are the allowed and disallowed expenditure for a business. So now the deductible rule that first is that uh, expenditure can be only deducted from which the tax is applicable to them. So for a financial period Jan to December, the first tax period begins from 1st January 2024. So any expenditure being incurred from 1st January 2024 and it is pertaining to the only business for the business purpose, commercial purpose, that can be deductible. So now generally what would happen, so now your November and December 2023, and if you have any incurred any expenditure for which you're making a payment in 2024, can those expenditures be allowed to be deductible? Those expenditures will not be allowed to be deductible. Generally, it would happen that you will not receive electricity bill for December month. You will be receiving in the January period, and you will make a payment of those expenditure in January 2024 or February 2024. Those expenditure which are pertaining to 23 will not be allowed because your first tax period begins from 1st January 2024 onwards. So any expenditure pertaining to that period or from which your tax is applicable, those expenditure can be deductible. And those expenditure has to be for the business purpose. There could be some personal expenditure of owner driven company, there could be some travel expenditure, his personal expenditure, those cannot be deductible. And though expenditures should not be in capital nature, because for the capital expenditure those are allowed to be deductible as a depreciation. So like if a company has bought a car or vehicle, so those generally the expenditure, there's a depreciation on the car or any machinery or like a computers they purchase, which will be depreciated over a period of time. So the expenditure of depreciation will be not allowed to be adjusted as an expend deductibility. And then those should not be related to exempt income. So now what are exempt income? It could be like, we'll talk about the next slide, which is like your expenditure being, if you dividend is an exempt income. So any expenditure incurred on getting a dividend, which is basically companies investing in other company from which on which he's be getting a dividend. So the fund is borrowed for investing in other company. So the interest paid on that fund for borrowing and investing in other companies, that interest expenditure on borrowing it and investing it will not be allowed because that dividend is an exempt income. And any other expenditure which time to time government will declare or cabinet decision will declare, that need to be taken care of. And there could be an expenditure which could be partly for business, partly for personal expenditures. For example, telephone expenditures or a vehicle expenditures. So telephone expenditure can be used for your personal, for the business purposes. So there need to be a documented contract clearly mentioning that 60% of the telephone bills can be considered as a company purpose and 40% would be for the personal purpose, because you cannot track each of those calls. So there could be a contract between the company and the employee as a policy. Then only 60% would be allowed as a company deductible expenditure and 40% will not be. So now the documentation become crucial once the corporate tax is getting implemented. So now certain expenditure which are not deductible. The first expenditure is pertaining to the donation or grants. So donation grants given other than the qualifying public benefit entity. Now qualifying public benefit entities are the list of non-commercial, non-profitable organizations, which the government or the federal tax authorities releases, and is there any charitable contribution being made to those list of qualifying public benefit entities, only those donations are allowed. If the donations is made other than those qualifying public benefit entities, then those expenditure are not deductible. The other point is with respect to the input value added tax, which are not claimed. Now, say for example, for telephone bills or fuel bills, where the value of input value added tax is very small, because if your telephone bills could be 100 or fuel bills are like very small amount, and you don't track those value VAT amount of those telephone bills or the fuel bills, and you are not recovering that from your output where you are eligible to recover it from your output VAT, then those portion of VAT, input VAT, which is not recovered, you have not claimed it from your output VAT, then those expenditure cannot be claimed. So suppose 105 is your telephone bill, that means 100 plus 5% VAT, so 105, and that 5 portion is not recovered from your output VAT, then that 5 will not be deductible expenditure. You can only deduct 100 telephone bill. The 5 portion will not be deductible. So you have to add back. That adjustment has to be done when you are computing your taxable income. And as well as any bribes or illicit payment, of course, that is not promoted, and those expenditure cannot be deductible. Then with respect to the entertainment expenditure, it is limited to 50%. Now, what are the entertainment expenditure? These entertainment expenditures pertaining to your customers, shareholders, suppliers, business partners, and like a kind of meals arrangement or transportation or any kind of club fees being paid on behalf of your customers or shareholders, then the expenditure is limited to 50%. So company suppose has incurred 50,000 in 2024, then out of 50,000 only 25,000 will be deductible expenditure. Now when the entertainment expenditure pertaining to the employee, generally company would arrange a get together annual event or any kind of specific event for their employees. For if expenditure being incurred for employee, it will be 100% allowed to be deductible. So now companies has to rearrange the chart of accounts to keep a separate track of expenditure being incurred for the customer, shareholders or suppliers or business partners. So because that is limited, entertainment expenditure for them is limited to 50%, whereas for employees it is 100% allowed. Then then your non-deductibility of penalties or fines, because if any kind of RTA fine is being paid or your VAT penalty is being paid, those are not deductible, because those are like not following the laws or compliances to laws, non-compliances that will not be allowed to be deductible. Then dividend and profit distribution. So dividend and profit distribution is distributed out of the profit, taxable profit. So when you have already paid a tax out of the profit, so that dividend what you are distributing is not a, it's just a portion of profit being distributed. So that's not any kind of expenditure being incurred. So that will not be allowed to be deductible. And with respect to the interest amount, the net interest beyond earning before interest, tax, depreciation, and amortization, there's a limit of 30%. But now this threshold limit has been increased up to 12 million. So either it is 30% of EBITDA or 12 million, whichever is higher is allowed, is allowed to be deductible. So I mean, if it is going beyond 12 million of your interest amount in a year, then like if your company is incurred 13 million, so I mean, up to 12 million it can be allowed to be deductible expenditure, but 1 million additional, which is 13th million, will not be allowed to be deductible. And any kind of tax on income which is outside or within the UAE, the foreign income tax or corporate tax, the tax is not an expenditure which can be deducted, so that won't be allowed to be deducted. And then the small business relief, which is applicable for a specific period of time. Now there's a threshold limit of 3 million revenue. So any businesses which revenue is less than 3 million, then they can claim for a small business relief. And this threshold limit of 3 million has to be computed as per the IFRS accounting standard of revenue reporting, which is IFRS 15, that the revenue has to be computed as per the accounting standard, because authorities can be asked for the record keeping of how you have computed the threshold limit of 3 million. And the benefit of this is that they won't be paying corporate tax. The corporate tax documentation is not required, and they will not be paying the tax. But then the other they would have like they cannot carry forward the losses, or they cannot adjust the losses within the group. There are other plus and minuses of going for a small business relief as well. And this small business relief is for a period up till 2000 December 31st December 2026. So it is given like this is for a small period of time up to which you can claim to be eligible for small business relief, where you won't be paying that tax. And this, in case no, this if you exceed the threshold, like if you in 2024 you had a you had a revenue of 3 million, but in 2025, if it exceeds more than that, then you cannot claim that benefit in future period. So if you see what are the benefits of having or not having this small business relief, the corporate tax registration is required even whether you have an income less than 3 million or not. You still have to register for that. Then filing of return. So you still have to file a return, but then the declaration or the information required to be filed when you have elected for small business relief is, it is very small. It did not be so much detail. Whereas if you are not elected to be a small business relief, it is a full detailed description to file in the return, because you would be paying the tax. And when you elect for the small business relief, when you're filing your first return, then you elect there in that form to be a small electing for a small business relief. And the taxable income computation is not required when you have already opted for small business relief. Whereas if you have not opted, then you have to compute the tax liability. And then interest expenditure carry forward, which is up to 10 years period. The interest expenditure can be carry forward up to 10 years period. That benefit is not eligible for a small business relief, whereas a person who has already opted for to pay tax, they can be eligible. Qualifying group is not eligible for the small business relief. Then transfer pricing documentation is not required for a person who claim to be a small business relief, whereas a person who's going to pay the tax, they have to follow the documentation requirement of transfer pricing. And with respect to the arm's length principle, the arm's length principle is applicable when there is a transaction between the connected party or related party, that would still be applying to both small business and those who have not opted even for the small business. Then with respect to the accounting basis, whether to follow cash basis or accrual basis, so the cash basis is optional to both opting for small business and not small business, because there is a threshold of 3 million. If your revenue is less than 3 million, you have an option to maintain your books of accounts on cash basis, or you can opt for following the normal accrual method of accounting. Then in terms of reporting requirement for IFRS reporting requirement is only to meet the threshold limit of 3 million. So to declare your threshold limit of 3 million, you have to calculate the revenue as per the IFRS requirement. Whereas who has already opted not to claim the benefit of small business relief, so he did not follow the IFRS standard. It could be normal record keeping, he can do that. Now, I I invite Balram to take over the next next topics, the qualifying free zone, and whatever queries you have raised in the chat box, we will address it at the end of the session. So Balram, please take over the qualifying free zone.
So thank you, Manish, for taking us through the initial provisions of the law. Now let us look at the qualifying free zone related provisions. Just to give you a brief understanding of this, just today itself we got one cabinet decision as well as ministerial decision on qualifying free zones, or free zones rather. These are not these are a replacement of earlier decision that FTI has released, or ministry has released. So we try to incorporate those changes, or the slides that we're going through are based on the changed decisions. But however, we still need to look at them more carefully and to understand what is the implication of the changes that they've made. But yeah, we try to cover as many as possible. So for any free zone company to be considered as a qualifying free zone person, they need to comply with the conditions mentioned on the screen. The first and foremost thing is to maintain adequate substance in the state. So when they said adequate substance in terms of the employees, office year and expenses, as well as asset base that you need to conduct the business, is being here in the free zone. Either you can have your own employees, or you can outsource the employees, the work to the outside people who can be in free zone. That could be a third party or related party. But as long as you have the control on the activities of those people to conduct the activities, then it is sufficient to mention that we are meeting the adequate substance. We'll talk more about adequate substance in the following slide as well, because we have economic substance regulation comparison as well. And the company, free zone company, should be deriving qualifying income. Definition of qualifying income we'll see in the following slide, as well as the de minimis. The third point of satisfying de minimis requirement also will be looked at in the following slide. And next thing is to the company, free zone company should not be electing to be subject to tax with the normal rates. Normal rates, as Manish mentioned, if it is a mainland entity, you'll be paying tax of 0% up to a taxable income of 375,000 dirhams and 9% in excess of that. So a free zone company, if it is electing to be subject to tax as normal with normal rates, then it will not be considered as a qualifying free zone person. If it is not doing so by complying with other conditions, then they can become qualifying free zone person. And if the free zone company has got any payments or transactions with related parties or connected persons, then they have to comply with arm's length principles or transfer pricing guidances. That also the FT has released, ministry has released a guidance on transfer pricing requirements recently. So the company should comply with those guidelines. And the last condition is that the free zone company should maintain their books of accounts and get the books of accounts audited on regular basis to get the status of qualifying free zone person. So any free zone company which is qualifying or meeting these conditions will be considered as a qualifying free zone person, and in which case the profit of the company will be subject to tax at 0%. So that is the benefit of getting the status of qualifying free zone person. So if a qualifying free zone person does not meet any of these conditions that we mentioned, so they lose the status of qualifying free zone person in that year. Plus, in the subsequent 4 years also, they will not be able to get that status. So it is this year plus following 4 years, they will not be able to get the status of qualifying free zone person if they don't meet any of the conditions mentioned above. As I mentioned, these activities can be outsourced to any third party or related party as long as you have control over the activities of those persons in the free zone. In addition to this, a qualifying free zone person or a free zone company, if it is part of an MNC, a larger MNC, which has got revenue or consolidated revenue of 750 million euros or more, then there's a possibility to that company a higher tax rate could be applicable. This is under the requirements of OECD Pillar 2 implementation thing. Initially, Manish mentioned about OECD, so UAE also is a member country to the OECD, and this is not implemented yet. So it is expected that they may come out with implementation in 2024. So once it is implemented, the entities falling in that particular group, which are in UAE, the group can be here or outside, and to them, the higher tax rate could be applicable, which could be a 15% effective tax rate. So just to quickly give an understanding of what is adequate substance, as I mentioned, so the free zone company should conduct their core income generating activities in the free zone. On the left-hand side, you have corporate tax related requirements of some adequate substance. And right-hand side, we have economic substance regulation related. There's another law which is applicable to some of the activities, some of the businesses conducting activities, specified activities. So the substance is required under that law also. So the substance requirement is more or less similar in both the laws. However, there are some places where there is a difference. But Ministry has clearly mentioned that they are going to come up with amendment to this economic substance regulation also, wherein both of the requirements, both the laws requirements in terms of substance will be similar. But both of them primarily are talking about the asset base being here, employees being here to conduct the operations, and your operating expenses being spent here, as well as the office space being here to be able to conduct the size of the business or activity that you claim. So that much should be here. So if you're saying that my business is 100 million dirhams, so you should maintain all these employees, asset-based operating expenses, as well as office to be able to cater to that size of 100 million business. So that is what is the primary requirement of having substance in UAE. So in corporate tax, they mentioned about the free zone entities, whereas economic substance regulation is applicable for any entity, whether it is in free zone or on mainland, as long as they are conducting the activities mentioned in the law, and they are expected to maintain the substance. So for a qualifying free zone person, if they have qualifying income, then the profit is subject to tax at 0%. If they have non-qualifying income, then the income from that particular non-qualifying activity is going to be subject to tax at 9%. In addition to this, any free zone, which is not a qualifying free zone person, maybe by not meeting the conditions that we discussed earlier, then they will be subject to tax at a normal rates, which is nothing but 0% up to 375,000 dirhams. 9% in excess of that. So for a free zone company, so these could be the three scenarios that you may see. So let's see what is the definition of qualifying income. They mentioned income from any another free zone person. Your client base or your clients are a free zone person, and you are not conducting excluding activities, then that income can be considered as a qualifying income. We'll look at the list of qualifying activity and excluded activities in the following slide. Second point talks about income from qualifying activities. So your client base could be mainland, free zone, or outside UAE. As long as you're conducting qualifying activities, then your income is subject to tax at 0%, subject to meeting the other conditions mentioned earlier. This third point is a new one that is included in the updated replaced decision. So that talks about income derived from the ownership or exploitation of qualifying intellectual property. So they have given the definition of qualifying intellectual property. So the intellectual properties are generally the software, the patent rights, trademarks, and so on. They excluded few properties, but however, they considered significant types of intellectual properties to include in this. So you have any income out of this? Mainly the software industry. For them, it is going to be benefiting provision. Earlier, they were not including this. They were considering this as excluded activity, which means any income generated out of this intellectual property was subject to tax at normal rates. But now they included in this. Of course, you have to look at the qualifying intellectual property definition and other conditions that they mentioned about this. But yes, so there's a probability that you may get into this 0% tax benefit bracket. And the last point is that other income subject to de minimis. You may have income generating from these three activities mentioned earlier or above. But you may also have other income coming from any other activity that is still fine to consider as a qualifying income as long as that is very minimal. What is the minimal here means they mentioned de minimis. De minimis is a definition they have given. What is de minimis is again defined in the following slide. We'll talk about that. So this is with respect to qualifying income. Your income is falling in this qualifying income activity, so it is subject to tax at 0%. The second box talks about non-qualifying income. If you have any income coming from these activities, that will be subject to tax at 9% without any base of 375,000 dirhams with 0% tax. So any income, irrespective of the amount, whether it is 10 dirhams, 100 dirhams, or 1 million, the entire amount will be subject to tax at 9%. So what are those activities? Any income or a revenue that is coming from immovable property, which is in free zone. And that immovable property is a commercial property and that is being let out or sold to a non-free zone person. Then it is non-qualifying activity. And that immovable property in free zone is a non-commercial property that is given to any, whether free zone entity or non-free zone entity. That entire income is considered as non-qualifying income. Not only that, revenue coming from domestic permanent establishment and foreign permanent establishment of the qualifying free zone person will also be considered as non-qualifying income. One is quickly touch base on the permanent establishment, but here domestic permanent establishment means a free zone company. They have an employee who is regularly working from their home in mainland, and he is conducting a business activity related to that qualifying free zone entity. So habitually he's been working from here, conducting business, and then everything is done from his own house in mainland. Then that particular home from where he's conducting the activities or business activities of free zone company could be considered as a domestic permanent establishment. Same goes with foreign permanent establishment. So there are various other scenarios or instances which could be considered as domestic permanent establishment. And any income generated out of that particular domestic permanent establishment will be subject to tax at 9%, and rest of it can be falling under qualifying income based on the meeting other conditions. So this is what it is about non-qualifying income. So let's quickly look at the activities that they mentioned under qualifying activities. So they mentioned about goods and they also covered about services. So let's look at the goods quickly. Manufacturing of goods or materials, processing of goods or materials, trading of qualifying commodities. So these qualifying commodities to be traded on a recognized stock exchange, so not the regular ones. Any commodity, a qualifying commodity, which is tradable on a recognized stock exchange, only then that income or that activity qualifies to be a qualifying activity. This is a new activity included in this latest decision. And then fourth point is distribution of imported goods or materials. This primarily talks about entities which are in designated zones, and those goods should be sold to a reseller and not to end user. And if you are moving the goods into mainland, so they should be routed through designated zone. The goods should physically be routed through designated zone. They should be lying in either designated zone, or if they are coming from outside of UAE, they should be routed through, physically passing through that designated zone. That should be sold to a reseller. If all these conditions are being met, then only the activity will be considered as a qualifying activity. So in this, though the latest decisions have been released, but still the confusion with respect to the third port shipment and high sea sale is not clear. At least we are not clear about that. So we have to wait and see if there is any further guidance that they are going to come up with to include them also. As of now, it is still the same. So we're not really clear about this. And service activities like holding of shares and other securities, ownership, management, and operation of ships, reinsurance of services, fund management services, wealth and investment management services, headquarter services provided to related parties, treasury and financing of services to related parties again, financing and leasing of aircrafts, including engines and rotable components, logistics services, and ancillary activities to the above activities. All these can be considered as qualifying activity. If your business is conducting any of these activities, then your income could be falling under 0% tax bracket, subject to meeting other conditions. Excluded activities, if you are conducting any of these activities, then you will be subject to a tax at normal rates of 0% and 9% accordingly. So the list is like the transaction that you do with natural persons, a prison company doing as providing services and doing business with natural persons, they become excluded activities. Only exception is that if they are providing the services are being provided to natural persons relating to ownership and management of ships, fund management services, wealth and investment management services, financing and leasing of aircrafts. Any of these, if they provide to natural persons, they still be called as not considered as excluded activities. Other than them, they will be falling under excluded activities. And next is banking activities. They straight away follow excluded activities. Insurance activities other than reinsurance, financing and leasing activities other than financing to related parties, and financing related to aircrafts. Any other financing falls under excluded activity. Ownership or exploitation of immovable property, except the transaction with another prison person related to immovable commercial property in the free zone that we have seen in the previous slide. But other than this, will be falling under excluded activity. Any other ancillary activity to the above list also will be considered as excluded activity. So your business is conducting any of these activities, straight away will be applicable or will be subject to tax rate and normal rates of corporate tax. So let's look at the commercial and residential property related corporate tax provisions. Some of them we've already covered, but we wanted to focus a little bit more on them. If you're a free zone entity or a free zone commercial property, then if the property is a commercial property, then these three scenarios will be applicable. Accordingly, the tax will be, whether it will be taxable or not will be decided. So you have a commercial property, a free zone entity, and that is being provided to qualify. So you are a qualifying free zone person, and that is a commercial property. It is being provided to a non-free zone person. Then that income will be subject to tax. So this could be subject to tax at 9%, as you have seen in the previous slide. So you're a qualified free zone person and you have a commercial property, and you're letting it out to another free zone person. Commercial property, you are a qualified free zone person, a free zone person, and you're letting it out to another free zone person. Then that is that could fall under qualifying activity. That is not taxable as such for corporate tax purpose. And next, third thing is that free zone person and providing or letting it out to any other property to commercial property to a non-free zone person or any others. then it will be subject to tax. It could be at 9% or 0% and 9% accordingly. And a freezone person, second category is having residential property. So residential property straight away it is subject to tax, whether you let it out to a freezone person or freezone company, or you let it out to non-freezone person or entity. Straight away that entire amount will be subject to tax. So that is subject to the taxable transaction. If you have a property in mainland and any mainland entity, so if it is whether it is commercial property or residential property, if it is owned by a company, then it will be subject to tax. If it is owned by individual and that individual is not expected to have license, then it becomes a property owned by individual in this individual capacity. Then that is not subject to tax, that is exempted, as mentioned in the previous slide by Manish also. But however, if that individual is a owner and he is conducting or operating it as a business, maybe he has got his own team who is maintaining, running those property business or properties related activities, and he's also mobilizing funds from others and then investing into real estate and then doing those activities. So these could fall under the activities which are subject to, which are required to take the license and then operate or conduct, in which case that income will be subject to tax. So that's the difference. And any non-resident, if they have any property here, they may not have permanent establishment here, but the above rules will be applicable for them also. They will be subject to tax accordingly, whether it is individual capacity or in the capacity of company. So let's look at the provisions related to these properties or real estate from the point of view of VAT. So just to see or touch base on this VAT provisions or VAT rules with respect to real estate. So let's look at the place of supply, how the place of supply will be determined. So just to give a background, depending upon the place of supply, the taxability of the transaction under VAT will be determined. So that is the reason why it is important to understand. For a supply of real estate, including sale and tenancy contract, supply of any property based on the location of the property will be determined. So if the property is located within UAE, it will be subject to tax within UAE. And if it is the property located outside UAE, then there are other conditions to look at, but yeah, it could be out of the scope of UAE VAT law. So for supply of real estate, as I mentioned, so the first provision talks about the real estate as such. Either you let it out or sale, the transaction, whether it is going to be subject to tax or not, will be determined based on the location of the property. Now let's look at the services related to real estate. It's not the real estate property, but the services that are provided with respect to real estate. How the place of supply will be determined. So here they say supply of services directly connected to real estate property. They have given what will be considered as directly connected to real estate and what will not be considered. So if it is directly connected, then the place of supply is where the real estate is physically located. If that property is located in UAE, the services directly connected to that real estate is provided will be subject to tax in UAE. But if that property is located outside UAE, then the services directly provided or connected to the real estate may not be subject to tax in UAE. That could be out of scope from VAT point of view. So that is what is this is the last provision that talks about supply of services not directly connected to real estate. Then it's not directly connected. So in which case, so it could be a normal service, irrespective of the location. So that could be subject to tax in UAE under VAT law, whether the property is located in UAE or outside UAE. But we still need to look at it whether it becomes a standard rated supply or zero rated supply out of scope. So let's look at taxability and then how much amount of tax will be levied under VAT for properties. The property is in UAE and that is a commercial property. The commercial property can be any of these shops, offices, warehouses, clinics, and so on, whatever they mentioned. The last thing is that the short-term tenancy, which is less than 6 months, and given to a non-resident who is not resident UAE, that will still be considered as a commercial property. And if that commercial property is given on rent, then it will be subject to tax at 5% standard rated. So it will be standard rated supply. But however, if that particular commercial property is sold, okay, then we have to decide what will be the taxation or the situation of the taxation based on whether that building or the commercial property was occupied or given on a rent and the tenant is using it or whether not. So let's look at them also. If that particular property is not let out, it is a commercial property and you're selling that particular property to someone else and that is not occupied or it is not let out. Okay, so if that is the case, that sale transaction will be subject to tax at normal rates of 5% VAT. However, if that property was let out, okay, that was given on rent, then we have to see whether the value of that particular property's transaction or sale transaction, is it less than 375,000 dirhams, and the buyer, whether he is registered or not. If the buyer is not registered for VAT and the transaction value of the sale of commercial property is less than 375,000 dirhams, then also it becomes subject to tax at a normal rate of 5%. Whereas if that particular property is let out, commercial property being let out, and the buyer plus seller, both of them are registered under VAT, so the property is occupied by a tenant. So in that case, the transaction will be out of scope from VAT point of view. So another way to say it is that it is generally considered as a business. So when the property is given on let out and the tenant is continuing in that property, the sale transaction is generally considered as transfer of a going concern business. By considering that rule, so this particular transaction will be out of scope from VAT law, VAT taxation. When a commercial property is let out and that property is sold to another buyer, another person, and that buyer is also registered for VAT, in which case the transaction will be out of scope. But under VAT law, any residential property, whether you sell it or lease it out, that is exempted. That we know already. So supply of supply of real estate within the designated zone. So that is not considered as a supply, and hence it will be out of scope from VAT law. That's why you don't see any taxation levied on the real estate property in designated zone. So just to give or re-emphasize on residential buildings related the VAT taxability. So what generally, as we discussed earlier in the previous slide, residential building supplies, whether it is sale or lease, are generally exempted, which means you will not be levying any tax. At the same time, the tax paid on expenses related to those buildings cannot be claimed as input tax credit also, right? That's the general rule. But however, in few exceptional cases, the supply of residential buildings, whether it is lease or sale, will be considered as zero-rated supplies. And in which case, though it is zero-rated supplies, the tax levied on that will be, the VAT levied on that will be zero. However, whatever tax we pay on the expenses related to that particular building, maybe for construction or for maintenance of it, you can claim that as input tax credit. Okay, so that's the difference. So when will the residential building supply will be considered as zero-rated supplies? In these three scenarios where they mentioned here, will be considered like that. So first thing is that the first supply of residential buildings within first 3 years of its completion. So you have constructed a building and you are supplying that for the first time within 3 years of its completion. So that supply could be leasing it out or sell it out. So that first supply after completion of a building will be considered as zero-rated supply. What does it mean? So your sale or lease will be subject to tax at 0% of that. Whatever tax you paid on the building construction or getting it developed, the tax of that amount, you can claim that as input tax credit. Okay, so they want to give a relief to the developer or builder by way of this input tax credit of VAT paid on the construction cost. So that is first scenario. Second scenario is first supply of buildings after conversion of the buildings for charities. And first supply of buildings when commercial property has been converted to residential property, then also first supply will be considered as zero-rated supply. So in these three scenarios, residential building will be considered as zero-rated supplies, and in any other scenarios, supply of residential building will be considered as exempted supply under VAT. So these are the various other provisions with respect to real estate under VAT law. Just wanted to give a quick look at them, a quick brief of the provisions. We have discussed about commercial property and residential property, but we also need to see what are the other business activities related to the real estate, whether they'll be subject to tax or not. So any company which is providing maintenance of buildings, maintenance services to buildings, they'll be subject to tax when on normal rates of 5% VAT. And owners association and other related services also will be subject to tax at standard rate. Any electricity, water, gas, and cooling services provided to real estate companies, these services also be subject to tax at 5% under VAT law. Real estate agent fees, their fees also will be subject to tax at 5%. So all other services of businesses that are related to real estate will be subject to tax at 5% in general. What happens to the developers? So you are a developer of the property and you're providing services. Of course, you are doing the construction and all those things. So in which case the developer is expected to register themselves for VAT. Of course, you have to look at the other conditions also from registration point of view. And then the construction related expenses and all those things, the suppliers to you will be billing you. So you have to pay VAT on your construction cost or on your cost related to your business. And if you are supplying or selling a new built house, as we have seen in the previous slides, that becomes a zero-rated supply if it is residential. If it is commercial, of course, it will be subject to tax at normal rates of 5%. Okay, so this is what with respect to developers. Now, if you are taking any services, providing, if you're non-resident and you're providing some services with respect to the real estate property, then can we consider them as reverse charge import of services? So they clearly mentioned that the place of supply of property located in the UAE is always in UAE. Non-resident is the owner of a property in UAE, and that non-resident is letting this out property in UAE to someone else or selling it out. So because he is a non-resident who is providing service, so will that be considered as an import? So to the buyer. So the answer is that it's not. We cannot transfer that as an import. By the way of having the property in UAE, so that non-resident becomes a resident for taxation purpose, and they are expected to register for VAT purpose and then comply with the rules accordingly. So that's how it is mentioned clearly in the guidance. And another scenario is that you are purchasing a commercial building. What happens to them? So if a commercial building value is more than 5 million dirhams, so then it will be considered as a capital asset. There are different rules given for capital asset under VAT law. You will claim the entire amount of tax paid on that particular purchase of the building in the period in which you purchase it. But at the same time, you constantly need to check whether you are using that particular property for residential purpose or for commercial purpose, or are you using it for partly for residential and commercial. So accordingly, the adjustment related to the input tax that you already claimed will be done in the respective years. So there are different rules given for that particular capital asset related item treatment under VAT law. So they have to comply with those rules. And if the residential property has been built for a UAE citizen, and that is for his own residence purpose that he is doing, getting it built. So any tax paid on that will be given as a refund to the UAE citizen, and they need to apply for this, and then it can be done within 12 months from the construction or occupancy of the particular building. And subject to meeting other conditions, the tax paid on them or VAT paid on them will be given as a refund to the UAE citizen. So it is only to be given or will be given to the UAE citizens and not to others. So this is a quick summary of the VAT applicability to the transactions. Most of them we have already covered in the previous. So if you are supplying a commercial property, then it is going to be subject to tax at 5%. If you are supplying a residential property, generally it is 0% if it is a new property, as we have seen in the previous slide. If you're supplying an existing property, not other than new residential property supplied within first time for the 3 years, then it is exempt. Supply of bare land is also exempted supply, and the supply of covered land, if it is covered with whatever it is, and then it is going to be subject to tax of 5%. And a first supply of a charitable building, that also will be subject to tax at 0%. A subsequent supply of a charitable building after first supply becomes a supply with 5% VAT. A property located within designated zone is out of scope. So this is a quick summary of the applicability of VAT for real estate or commercial other properties. So now let's look at the related parties transactions and transactions with connected persons. This is another important area where for most of the entities businesses it is applicable. We need to clearly understand whether we have transactions falling in this or not. Unless we look at them carefully, we do not realize that this is applicable. So a juridical person owning another company or another juridical person, and that ownership is more than 50%, it could be ownership or control, then both these companies will be considered as related parties. Not only this, company A is owning company B, and company B is having ownership in company C. And effectively, if this ownership is more than 50%, or control is more than 50%, and all these three companies, company A, B, C, will be considered as related parties. In addition to this, owner of the company, if he is having 50% or more ownership, will also be considered as a related party or connected persons to the company. So there is another definition called connected persons, which is not generally given in other countries, a few other countries at least. Since here we don't have individual taxation, so any transaction that is done with the connected person will be considered as a related party transaction again. Who are connected persons? Connected persons are those who is the owner of a company, or director of a company, or an officer of a company who is at influential position, plus their relatives. All this will be considered as connected persons. Any transaction a company is doing with these individuals will be considered as related party or transaction with connected person. And we need to make sure that the transactions done with these related parties are connected persons by company or at arm's length. So this is a illustrative list of the transactions that you may have with connected persons. Like owner, director, or the officer may take salary from company, or they may get perquisite from the company, or the owner may give the property, a commercial property, to the company on let out, and then he may collect rent on that particular property. Owner may give loans to the company and then take interest on those loans, or any other similar transaction that owner is doing, director or this officer is doing with the company. So all those transactions will fall under the payments to connected persons. In which case, these transactions should be made. We need to make sure that they are dealt with at arm's length. Which means arm's length means they are at a market rate. If you do the same transaction with any other unrelated third party, what amount would you pay to those services or to those transactions? That is what you have to pay, or you're expected to pay to these connected persons also. So that's what we have to look at. These are a few transactions that we can otherwise see as related party transactions. A group level HLOT contract. So a group company is having a contract with HLOT for all the numbers or connections of the group entities. So now here the parent company or one group company is taking care of all this, and then it is paying the amount to the HLOT. But whereas the services are being enjoyed by the different companies of the group. Now the group or the parent company is expected to transfer this cost to the respective entities, and that transaction should be at market rate or arm's length. And next service is that centralized corporate services function for the group. This is very common for a group to have centralized corporate services being provided from one entity of the group, and this service is provided to the other services in the other entities in the group. So obviously the other groups are getting the benefit of this service. So the parent company or the company which is providing this centralized corporate services is expected to charge some cost to these individual entities based on the service that they are taking. This also should be, there should be a documentation in place. Contract should be there. How are you allocating the cost to the different entities and what is the basis? All those should be clearly mentioned in the contract, and documentation is required to be in place. Not only that, so a particular employee of a company A is working for company B within the group. This is also very normal, a common scenario in UAE, in many other groups. So for the services that this individual is providing, since he's an employee of company A, but services are provided to company B, company A is expected to raise an invoice or charge the cost to the extent of the services to company B, so that your profit and the expenses are accounted properly, and your profits of this company A and company B are also being computed properly. And the amount that you charge also should be at arm's length or at market rate if you are also ever providing the services. And the other point is like salary payment to owners or connected business, which you have seen in the previous slide. That should be at market rate. And you need to make sure that the benchmarking is done for those services or transactions. We look at it quickly in the following slide. Goods supplied by company in India to company in UAE within the group entity or within the group. So you have company A in India and company B in UAE. Both of them are part of the group. And those goods are supplied in order to do further trading by company B in UAE. So in which case the transaction between company A in India with company B in UAE, the transaction should be at arm's length. Which means if this sale was done to any other third party under the similar conditions, what amount of rate would you charge? The similar amount of rate you should be charging on to this transaction between company A and company B also. So this is what is expected. So these are the various category of transaction that you may have between entities within the group or with the parent company with other subsidiary companies in the group. So if you conduct any of these transactions, you need to make sure that the transactions are dealt with at arm's length. There are various methods given as to how you compute to make sure that they are at arm's length. Depending upon the type of transaction industry you are in, and the method will be applicable, which is most relevant to that particular transaction should be applied. If the ministry also has released guidance on this, and they mentioned clearly, they are following these OECD guidelines, which is generally been followed by many other countries for transactions with related parties. We have an exclusive or specialized team on this, which can provide services to do benchmarking and also to come up with a policy with respect to these transactions, and also to make sure that the other compliances with respect to these transactions are also being complied with. Accounting records, let's look at the last leg of the session. What kind of accounting records you need to maintain and how long do you need to maintain? So they mentioned that 7 years after the end of the financial year under corporate tax law, which means 8 years in effective, you need to maintain all your books of accounts and records in place. Under VAT law, they mentioned it as 5 years from the end of the financial year. And who all are expected to maintain those books of accounts for corporate tax? In the corporate tax, they clearly mentioned that all the taxable persons as well as exempted persons, they are expected to maintain the books of accounts. And do you require to have your books of accounts audited? They mentioned under corporate tax law, if your turnover is 50 million dirhams or more, then it is must to have your books of accounts audited. And if you are a fusion company and falling under qualifying fusion person definition, then also you are expected to have your books of accounts audited. It is one of the mandatory condition to comply with. What are the penalties if you do not comply with the record maintenance? So under corporate tax law, they mentioned that if it is if you are not maintaining the records of books of accounts and documents, then for first violation it is going to be 10,000 dirhams, and for subsequent violations within 24 months from the date of first violation, then it is going to be 20,000 dirhams. And sometimes the FTA may ask you to provide the data in Arabic. They allow you to maintain the books of accounts and then submit the reports in English. But if they ask you specifically to submit the records in Arabic, then you're expected to do so. If you do not do it, then there is a penalty of 5,000 dirhams. So when you say books of accounts and then records, what kind of records do we need to maintain? So I mentioned that we have to have a balance sheet, profit and loss account, cash flow, of course, is required. Record of your wages, salaries, records of fixed assets, inventory records, and then statement along with the physical asset, stock count records, and any other specific transaction related records if it is significant to your business. So all those should be maintained. What kind of document supporting that you have to maintain? All your business related correspondences, invoices, tax invoices, licenses, and agreements, contracts related to your business, all these documents should be maintained. You should maintain them for 8 years. And taxpayers records of various elections. So you have various elections to be elected as part of compliance of corporate tax law. So the records are supporting documents related to that. Assessment, determination, calculations related to business. As part of compliance, as we have seen, some of the expenses are allowed to be deducted for corporate tax and some others are not allowed to be deducted. Whereas in your books of accounts, you'll be taking everything as expense. So for this purpose, now you have to maintain a reconciliation. Like, you have taken everything in your books of accounts, but whereas for computation of taxable income, you are removing some or adjusting some transactions. So the reconciliation of all these and supporting documents for them should be maintained. Documentation with respect to related party transactions should be maintained, and you should have proper documentation to make sure that or to demonstrate that the transactions are dealt with at arm's length. Record of fixed assets, and you can maintain the books in English or records can be in English, unless otherwise FT asks you to specifically submit in Arabic. Registration is mandatory for all the companies unless your company is exclusively exempted from doing so, which is very limited. And it can be done online in Imara tax portal. And there's no registration threshold under corporate tax law. Under VAT law, we have that registration threshold, but not in corporate tax law. So every company, including regional companies, whether you have business or not, whether you have profit or loss, every company is expected to register for corporate tax. And they've already opened the registration processes for LLC companies, PJSC companies, and individual or natural persons. And when should you have your registration completed? You can complete your registration before you file your first corporate tax return. And how do you submit your corporate tax returns? It can be done online, and it can be done through the same Imara tax portal. They do not have any other quarterly corporate tax returns. It is only yearly corporate tax returns. You'll be doing it once, and that will be done within 9 months from the end of the financial year, and that can be done electronically. So if your company's financial year is from 1st January, first financial year to which corporate tax applicable is 1st January 24 to 31st December 24, then you are expected to complete your corporate tax return filing before 30th September 2025, which is 9 months from the end of your first financial year. And this cycle is going to be same for following years also. This is a basic template of your corporate tax return as to how it can look like. This we prepared based on the provision that we have in the law. The important thing to note here is that the accounting profit and losses will be considered as a basis. So profit as per your books of accounts, which you prepared under IFRS, will be taken as the basis. And that profit will be adjusted plus or minus by looking at the various deductibility of expenses and non-deductibility of expenses, exempted, non-exempted incomes, and other adjustment that we have discussed so far will be made adjusted, and then you'll arrive to the taxable income. Profit plus or minus these adjustments will arrive to the taxable income. On that, you will compute the tax payable amount based on the threshold that we have, 0% up to 375,000 dirhams, and 9% in excess of that. If you are qualifying for 1%, 0% on total amount. And then you'll adjust the other tax amounts that you paid outside UAE or whatever it is, if you have any reliefs. And then you'll arrive to the final tax payable amount. This is how generally tax will be computed and net tax liability will be arrived to. These are the key areas to focus on. Like now we are already approaching most of the companies since they have January to December as their calendar year or financial year. So from 1st January 24 onwards, it will be applicable if you have that financial year. If you have different financial year, it will be different, of course. For some of the companies, the corporate tax is already applicable. For some others, it's going to be from January onwards. You need to make sure that you still have a little bit of time to make sure that you are reaching or you're having a tax optimized status But otherwise, you can look at all these areas to get to that tax optimization status. So review of your corporate structure, you need to make sure that what kind of corporate structure do you have. You have to make any changes to your ownership structure or group structures to get the maximum benefit. Whether you want to make any tax groups or not. Do you want to make entire group entities as one tax group, or you want to make different tax groups to get maximum benefit out of it? What kind of tax planning can you do by complying with the law? And then if you're a prison company, then how to make sure that you are getting the benefit of a status of qualifying prison person? What all do you have to make sure not to comply with? So these things you need to look at, and if there are any changes required, then of course you can do it. The only thing is that whenever you make any change to your structure, the way you do business, you need to make sure that you are complying with GAR. GAR is General Anti-Abusive Rules, which means if you're making any changes with the sole objective of reducing, minimizing, or avoiding taxes without having any other commercial reason attached to that particular change, then this could fall under GAR, in which case the FTA or ministry may say that whatever benefit you got out of this particular change will be moved out and it will be subject to tax as if this change is not being done. So that is the consequence of falling under GAR. So any change that you do, any plan that you do, you need to make sure that you are falling within the ambit of that provision. And other things are like, whether you have related party transactions or not, are you doing them at arm's length or not? If you have them, how to make sure that they are at arm's length? What kind of documentation? As I mentioned, you can take our services to get this done. And payments to connected persons, of course, you need to see. You also need to see whether you have any exempted income, and then will that be adjusted? Do you have to document them separately or not? What is the impact of the corporate tax on your cash flow, on your profit, on your debt equity ratio, and other ratios that you may have to look at if you have any facility from the banks? All these things you need to look at it now. From the point of view of books of accounts, you need to look at whether your chart of accounts needs any modification to be able to accommodate the requirement of the corporate taxes, so that at the end of the year, the computation of the taxes becomes easier. Do you have to make any changes to your systems, involve your IT team to make so, and any other expenses related to like non-deductible expenses and all those things you need to look at. If you have entities outside UAE, or if you have entities outside UAE owning entities here, so all those things you need to look at it and see whether you have permanent establishments or you are subject to tax in here as well as in outside of UAE. You have to look at or review your contracts and legal agreements with your suppliers, customers, and other parties. And of course, if you require any training to your team, uh, make sure that you have a training to your team. If you want any trainings on corporate tax or on VAT or any other compliance requirements, we can do that. We've been providing those services to various other entities. And if you want any impact assessment of corporate tax or simulation of corporate tax impact on your results of 2021 or 2021, that we generally do it. We conduct impact assessment on high level. We also conduct impact assessment on detailed basis. And then we help you in implementing corporate tax by looking at various requirements. We also help you in complying with corporate tax return filing or disclosure form return filing, as well as transfer pricing and other services that are required for corporate tax purposes. So these are the various areas that you need to look at and to make sure that you are ready to implement your corporate taxes. So you can reach out to us for any other services. Not only this, we also provide audit, accounting, value-added taxes, corporate tax and transfer pricing, of course, now, and internal audit and risk management services. Along with this, we also do company informations and PRO services. So these are the various services that we provide. You can reach out to us anytime for any service. You can send us an email if you have any doubt on the email mentioned here, and then we'll try to get back to you. And we'll quickly look at if you have any questions. If I think I see there are a few questions on in the chat box already. We'll try and address those questions. And also, if you have any other questions, you can mention in the chat box, and then we will try to address them. Or you can leave your email ID in this chat box. Most of the email IDs we already have. Otherwise, you can leave your mail ID in the chat box. We will try to share the recording of this session as well as the presentation in your email ID if you want us to share. So this is what we wanted to cover. As Manish mentioned in the beginning, these are only our personal opinions. If you have to take any decision, it is always advisable to look at the material released by the Ministry of Finance. That's the only source where you have to look at the law and related guidances and take your decision based on that. So yeah, so with this, we'll just end this particular session, but however, we'll look at the question and answer and then we'll address them.
So, Balram, I can take up the first question. I see that it is, can we use our losses from before our first taxable year to nullify our future taxable periods? As I mentioned that as the since the corporate tax is applicable for the financial period who has a period from Jan to December, it is applicable from 1st January 2024. So any losses prior to the applicability of corporate tax, like if you have any losses in 2023, you cannot carry forward those losses to be set off because tax period or taxability was not applicable for the 2023, so you cannot carry forward. So only with whenever your tax period is applicable, wherever the corporate tax is applicable for those period onwards only. So from 2024 onwards, any losses which you incur if you have a financial period of Jan to December, then only you can carry forward. So previous years losses cannot be carried forward. Then I see the next question is with respect to unclaimed input VAT is deductible under corporate tax. So now, if there is a recoverable VAT which you couldn't claim it, from your output VAT, that portion cannot be deductible. So say suppose if you have a telephone bill and then the amount is small, which is 100, and the 5% on that VAT is 5 dirham. So if you don't keep a track of that, which you could have recovered from your output VAT, then that portion it cannot be deducted. So you have to add back when you're computing your taxable income. Now there are certain VAT input which is not allowed to be eligible to be recovered from your output VAT. Say for example, your entertainment expenditure pertaining to the team meal being organized or team get together being organized. So the VAT expenditure, like if you have in companies incurred 5,000 in the team meal, so the VAT amount is 250 on that 5%. So that 250 which was not eligible to be recovered from your output VAT, so that becomes an expense, business expense. So that total 5250, the 250 which was a VAT input which you cannot recover as allowed eligible to be recovered, that is actual expenditure which you can be allowed to be deductible from your corporate tax purpose. So we'll have to bifurcate what is recoverable, what is not recoverable from an output VAT. So those which are not recoverable from your output VAT, you can deduct it, but which are recoverable and you're not claiming it from your output VAT, that cannot be deductible from your corporate tax for computing your taxable income. Then I see the other question with respect to whether small business relief to be opted at the time of registration itself. No, I mean, there is no facility or there is no field where you can apply for your small business relief at the time of registration. It has to be done when you're filing your first return. When you file your first return, then you have to opt, you have to declare that you are opting for a small business relief at the time of first return you're doing it.
The other point that UAE citizens, if they are constructing any if they're constructing any residential building by their own residence, so then it will be so you can claim a refund. It was 6 months earlier. I think there is a guidance on this. It can be claimed within 12 months also. But I can reconfirm this to you, Shiva. Yes, that's what is the answer for you. Can we be compliant with arm's length pricing without going for transfer pricing in the case of managers' remuneration? In the recent guidance, they mentioned that as long as a transaction is at arm's length and you have enough supporting documentation to show that it is at arm's length, it is fine. Unless if FTA asks you otherwise, then they did not mention that you are expected to maintain this documentation, transfer pricing and bench. So it's both the same. Only thing is that are you without having some basis, to make sure that they are at arm's length, how are you going to decide? So that's the main thing. So whether you are expected to maintain or not, but you're still expected to have that benchmarking done and make sure that the payment or transactions dealt with them are at arm's length. So there's no other way to make sure that they're at arm's length without following or having this transfer pricing requirements being complied with. So that's what is the answer. So you are expected to have a benchmarking done. I think that under substance requirement of corporate tax, place of effective management is to within the free zone. So they mentioned, so the generally the free zone entities are expected to be managed from the free zones. And if your substance needs to be complied with, you have to have your team sitting in free zone. If you are outsourcing it to another entity, so that another entity should be in the free zone. So it can be in the same free zone or any other free zone. That is not mentioned clearly. It is mentioned as a free zone, which could be same free zone or any other free zone. But yes, you have to have your management being done from there, from the free zones. Ideally from the same free zone. If it is outsourced, then it could be another free zone also. Say there's another question: if UAE citizen transfers residential property on which earlier they have claimed VAT, is such transfer will have any effect on that already claimed VAT? It's a good question. It becomes your regular residential property supply, right? So in which case I think it is exempted. That's what I think. But at the same time, UAE citizen, the primary expectation of this refund is that this UAE citizen is going to use that for his own residence purpose. And he does not have any other residence building or residence property for his own occupation or occupants, in which case then he will be able to get this refund. Yeah, that's what is the answer for that. Okay, so we have addressed the question that have been asked in the chat box. So if you don't have any other questions, as I mentioned, you can reach out to us by sharing your sending your questions on to the mail ID mentioned here, and we will definitely get back to you. So with this, we would like to end this session. Thank you all for attending the session, and we continue to conduct other sessions on other sectors of industry. Thank you all.